Today, I'll be breaking down Palantir's fundamentals. Palantir is in the spotlight, with its stock soaring and investors buzzing about its potential to keep climbing. The hype is undeniable, but is it reasonable to believe the stock will continue soaring indefinitely? Let's break it down. I always start with 5 dimensions, a proprietary system where I dissect the fundamentals of a business. Let's kick off with the first dimension, growth. Palantir's growth story is one of the most exciting in the tech space right now. Over the past few years, the company has seen its revenue climb from $1.1 billion in 2020 to an impressive $2.6 billion on a trailing 12-month basis. That's a 5-year compound annual growth rate of 24.7%, a remarkable feat for a company operating in both government and enterprise markets. But revenue isn't the only metric worth celebrating. Palantir has moved from a -98-cent EPS to 20 cents over the last 12 months, signaling improving profitability and operational efficiency. Palantir's free cash flow has also undergone a significant turnaround, shifting from -$1.6 billion in 2020 to $438 million today, proving the company's ability to fund growth sustainably. Now, let's shift gears to profitability dimension. In 2020, Palantir's gross margin was 67.7%, but as of the trailing 12 months, it stands at an impressive 81.1%. This stability above 80% is a testament to the company's scalable software platforms, which generate high-value contracts with relatively low marginal costs. Simply put, every new client brings in more revenue without a proportional increase in costs, driving exceptional profitability. Now, let's talk about operating margin, where the improvements are even more striking. Back in 2020, Palantir's operating margin was a deeply negative -107.4%. Fast forward to today, and the company has turned things around, achieving a positive 13.8%. This is a pivotal milestone for Palantir, marking its evolution from a cash-burning growth stage company to one with operational efficiency. Finally, we have free cash flow margin, which might be the most impressive transformation of all. In 2020, Palantir's free cash flow margin was a staggering -144.6%, highlighting its heavy cash burn. Today, that margin has flipped to a robust 16.5%, showcasing the company's ability to generate substantial free cash flow relative to revenue. Moving on to the solvency dimension. Palantir's solvency metrics showcase exceptional financial health and discipline. Starting with debt to equity, the company has significantly reduced its ratio from 0.30 in 2020 to an impressively low 0.06 trailing 12 months. Next, net debt to EBITDA has turned negative over the past 2 years, with a -0.89 trailing 12 months ratio, meaning Palantir's $2 billion in cash reserves far outweigh its $450 million in total debt. This positions the company as a financial fortress, capable of funding operations, driving growth, and navigating economic uncertainties without the burden of heavy debt. Finally, debt to free cash flow at 0.58 trailing 12 months highlights Palantir's impressive cash-generating efficiency. With this ratio, the company could pay off its $450 million debt in less than 7 months' worth of free cash flow. Now the important fourth dimension, valuation. So far, Palantir has scored a perfect 5 in every dimension we've analyzed: growth, profitability, and solvency. It's undeniably a brilliant business with strong fundamentals, impressive growth, and financial resilience. But now we turn to the critical question of valuation. Even for the most outstanding businesses, price matters. Paying an exorbitant price for a great company can turn a solid investment into a poor decision. Let's take Apple, for example, a company widely regarded as the best in the world. If Apple's stock price suddenly skyrocketed from $200 to $1,000 without any reason, would it still be a good investment? Of course not. At some point, the price must align with the business's future potential. This is the key issue for Palantir. Does its valuation reflect realistic growth expectations, or is it pricing in an unattainable future? Let's dive deeper. Palantir's EV to sales ratio of 62x is extraordinarily high, even by tech industry standards. For comparison, NVIDIA, a company with a 59.7% 5-year revenue annual growth rate and annual revenues exceeding $100 billion, trades at a lower multiple. Palantir's 5-year revenue annual growth rate of 24.7%, while impressive, pales in comparison. Looking ahead, analysts project Palantir to achieve a 30.3% annual growth rate over the next 5 years, reaching approximately $6.9 billion in 2029. However, even at that level, assuming Palantir's stock price remains at $66, its forward 2029 EV sales multiple would still be 23.8x. That's an absurdly high valuation for a company generating just a fraction of Nvidia's revenue 5 years from now. Does this seem like a good deal to you? Palantir's price-to-earnings ratio of 346x highlights a valuation disconnected from reality. Even with projected EPS yearly growth of 42.3% over the next 5 years, the price to 2029 earnings multiple would still be 90x. While 90x earnings might be tolerable if Palantir continued to grow EPS at 40% annual growth rate beyond 2029, assuming such sustained growth is highly unrealistic. As businesses scale, sustaining such high growth rates becomes exponentially harder, and Palantir's growth trajectory will inevitably slow. The AI and data analytics landscape is intensely competitive, with established tech giants and agile startups targeting the same markets. Assuming Palantir will face no competition or pricing pressure is wishful thinking. Now the fifth and last dimension is the shareholders' return. Palantir doesn't pay any dividends, which results in metrics like dividend growth, dividend yield, and payout ratio being naturally rated 1. When it comes to shares outstanding, the situation is somewhat concerning. Palantir's shares outstanding have more than doubled since 2020, increasing from 979 million to 2,460 million today, representing a staggering 151% growth in just a few years. This aggressive dilution is largely driven by stock-based compensation, a strategy designed to reward and retain employees but one that significantly erodes shareholder value. Here are the ratings for the first dimension metrics and their average. The second dimension, profitability. The solvency dimension is rated as follows. The fourth dimension, valuation. And finally, these are the ratings for the fifth and last dimension. In this table, we have a summary of this section. The 5 dimensions final rating is 3.4. Now let's move on to Palantir's DCF valuation. I employ Wall Street analysts' free cash flow projections to compute Palantir's fair value. The average estimates of the next 5 years are utilized for a base case scenario, the highest estimates for a bull case scenario, and the lowest estimates for a bear case scenario. The base case estimates Palantir's fair value at $19, which is 70.8% below the current stock price, highlighting significant overvaluation. The bull case values Palantir at $27, still 59.5% below the current stock price, further reinforcing the stock's overvaluation. In the bear case, Palantir's fair value is pegged at $9, a striking 86.5% below the current price. Moving on to the reverse DCF valuation method, we can uncover the growth expectations baked into Palantir's current stock price required to generate a 12% annual return, my required rate of return. By analyzing the free cash flow growth rate needed to justify its valuation, we assess whether the market's optimism is grounded in realistic performance or if the stock price is pure speculation. Often, large gaps reveal that the growth expectations embedded in the price are just lunatic. Let's dive into the assumptions and results to see if this method also highlights overvaluation for Palantir's stock. Assuming an exit multiple of 40x in 5 years, the results show the implied free cash flow growth needed to achieve a 12% annual return is 77.4%. A completely insane number. For comparison, Wall Street's projected free cash flow growth is 42.3% for the next 5 years. This leaves a growth gap of minus 35%. This discrepancy underscores that Palantir's current valuation assumes an exceptionally aggressive growth trajectory, far beyond what analysts forecast. The results suggest that Palantir's stock price is significantly overvalued, with growth assumptions that are difficult to achieve. This pricing reflects speculative hype rather than grounded financial expectations, making it challenging to justify the current valuation. My last valuation model is the expected yearly return. This model illustrates the yearly return you can expect as an investor. In theory, calculating your expected return is straightforward, and here are the assumptions I use. The expected yearly return breakdown is as follows. Expected EPS growth is projected at 42.2%. Shareholder yield is minus 0.2%, with no contribution from dividend yield, and a negative minus 0.2% buyback yield. Debt paydown yield is neutral at 0%. When it comes to valuation impact, the current PE is 346x, expected to compress to an exit PE of 40x. Altogether, this results in a total expected yearly return of just 7%. While Palantir's growth potential is extraordinary, the overwhelming valuation contraction significantly offsets these gains, leaving investors with a modest 7% expected annual return. This is far below my required rate of return of 12%, serving as yet another indicator that Palantir is highly overvalued. Now is the time to wrap up everything. We saw that in my 5 dimensions model, Palantir earned a great final rating of 3.4 out of 5. The company scored perfect fives in growth, profitability, and solvency, but its valuation and shareholders' return dimensions dragged the overall rating down. The high hopes sparked by Palantir's 5D analysis were quickly brought back down to earth by its inflated valuation. The DCF and reverse DCF models indicated significant overvaluation at the current price, with implied free cash flow growth assumptions far exceeding realistic expectations. Furthermore, the expected yearly return method projects an annual return of just 7% over the next 5 years, falling well short of my required return of 12%. While Palantir's projected EPS growth of 42.2% is exceptional, the drag from valuation compression weighs heavily on long-term returns. Palantir's growth story is built on strong positioning in AI and data analytics, with several promising drivers. AI integration, where the artificial intelligence platform has significantly boosted Palantir's commercial customer base by leveraging AI to tackle complex data challenges. Government contracts, which provide a solid foothold in defense and intelligence sectors, ensuring a stable revenue stream and opportunities for future expansion. Commercial sector penetration, where U.S. commercial revenue has grown 70% year over year, demonstrating successful diversification beyond government contracts. And finally, a scalable business model, as Palantir's software platforms allow for high-margin growth, onboarding new clients with minimal incremental costs. While Palantir's fundamentals are strong, several risks challenge its ability to achieve lofty growth expectations. Valuation concerns, as current multiples, such as a 346x PE and 62x EV to sales, assume perfection, leaving little room for error. Competition, because the AI and analytics sectors are becoming increasingly competitive, with startups and established players threatening Palantir's market share and pricing power. Government dependence, as over 54% of Palantir's revenue comes from government contracts, which may face growth limits due to budgetary constraints or geopolitical risks. Stock-based compensation, as heavy reliance on stock-based compensation dilutes shareholder value, reducing returns for existing investors. Palantir is an outstanding business with immense potential. Its innovative solutions, strong market positioning, and expanding opportunities make it a company worth admiring. However, admiration alone isn't enough. Price matters. At its current valuation, Palantir's stock is far too expensive to justify further analysis. Even the greatest companies can be poor investments if the price isn't right. Believing otherwise is simply a fool's errand. For now, I see no reason to spend additional time analyzing Palantir unless its valuation becomes more reasonable. Until then, this is where my journey with Palantir ends. Final verdict: expensive. What do you think? Are you bullish or bearish on Palantir's future? Let me know in the comments. I'd love to hear your thoughts. Don't forget to subscribe to my channel and stay tuned for the next analyses.